Welcome, everyone, to the Information's TITV. My name is Akash Pasricha. It is Monday, May 4th. We are kicking off the show today with new reporting the Information published about software firm SAP's efforts to block customers from using external AI agents to access data on their apps. We'll then bring on one of our AI reporters to discuss a scoop that they broke over the weekend. Anthropic is in talks to buy AI inference chips from a UK startup. We'll then discuss how fund managers are planning to raise cash to grab shares of Elon Musk's SpaceX when the company makes its eagerly anticipated debut. And we will wrap the show in conversation with a managing partner at Gradient, discussing how the venture capital world is thinking about all these big IPOs expected this year. It's going to be a fun show, so let's get right on into it. The corporate data wars are raging on as enterprise software companies grapple with agents pulling data en masse from their systems. My colleagues Kevin McLaughlin and Laura Bratton wrote about the dramatic lengths that SAP is going to protect its own house. I want to bring on Kevin to share more about what he's learned. Kevin, welcome back to the show. It's great to have you here.
Thanks for having me.
So what is going on at SAP, Kevin?
So last month, SAP published a document, which was a policy document for accessing its application programming interfaces. It looked like it might have been an accident, actually, because they didn't really have much messaging behind it. But basically, the document says if you are a customer of SAP and you want to connect your SAP data with outside agents, you will have to do it through what sounds like an SAP approval process. It could be like a specific product, or it could be some sort of authorization. But the language in the document basically amounts to an escalation in what we've been calling the AI data wars or the corporate data wars.
So this is a dramatic. I mean, this is a like we haven't seen before in the corporate data wars. I mean, we've heard about tolls, right? But this is you actually have to seek our permission.
Yeah, so what we've seen so far, it's been almost exactly a year since we broke the story about Salesforce's Slack unit changing its API terms in a way that made it harder for companies like Glean to do enterprise search on their Salesforce data. And since then, we've seen other measures taken by vendors like throttling, or what's known as API rate limits, which are also used for security purposes. But yeah, no one has gone as far as what SAP appears to be ready to do. And there's a couple of nuances here. One is that SAP says it's not going to charge customers for accessing their data through third parties. So it sounds like it's going to be a situation where SAP goes to other software providers that its customers also work with and says, we're going to need to renegotiate our existing agreements or form new agreements for this new world of AI.
Okay, that's interesting. So let's get a little tactical here. I mean, which companies are you hearing that they are having these discussions with? Do we know of any specific customer conversations?
It's all very murky at this point, and like I said, it feels like they might have accidentally posted this policy document. In conversations with SAP, they mentioned that they already have agreements with companies like Microsoft and Google and Amazon Web Services that allow customers to use their data freely. And it sounds like my guess would be that we're going to see more of these types of agreements with other kind of software providers, many of whom, most of whom SAP already works with. So my guess or my gut feeling is that the agreements are going to have to take into account agents, which wasn't part of the existing agreements before. SAP also said, because we asked them, what does this mean for Anthropic and OpenAI? And those companies, Anthropic and OpenAI, didn't respond in time for publication. But SAP mentioned that they it sounded like they're working with at least Anthropic on something. So SAP has this annual customer conference next week. I expect that we're going to be hearing a lot more about the new policy and very likely some sort of new agreements as part of this new policy.
Have you spoken to SAP customers about what their reaction is to this?
I spoke with licensing experts that work with SAP customers. I think the changes are so new, and like I said, were not broadly communicated by SAP, that I don't know that customers have really thought through the implications. But the licensing experts I spoke with certainly have. And one of them told us that it really looks to them like SAP is trying to change the rules mid-game. Now, there's a couple pieces here. One has to do with agents accessing SAP data. But SAP for a long time has been very concerned about customers mass exporting their data out into other platforms, ServiceNow, Salesforce, et cetera, in order to do analysis there. And it's important to note that SAP has always sort of operated in its own, what people call a walled garden in the enterprise software world, meaning that the rules have always been sort of different for them. The rules that the SAP has laid out have always been somewhat different. And so that's also part of this. I think it's just SAP is finally, for the first time, formalizing what their policies are going to be for things like AI agents.
So, Kevin, I want to sort of step back here a little bit. You said it's been a year since you initially broke that story about companies like Atlassian, all these companies trying to really hedge their, not so much hedge their bets, but really protect their own house in a world where startups like Glean are coming into the picture. I recall us having talked over the early parts of that story about how enterprise software companies were saying, "Hey, look, we're just there's nothing to see here, really." And I wonder how you have seen that conversation change over the last few months. It feels like this move from SAP is like the most stern move that we've seen, and so I guess despite the companies having said, "Don't don't worry about it," I mean, they're really going to dramatic lengths here.
Yeah, I think let's talk about like what specifically companies are going to charge for, because that part is really sort of, it's pretty complicated actually. But judging from what SAP told us last week, or actually what SAP's CEO Christian Klein said on their earnings call last month, they are not. It's not like the data that they're going to charge for, it's called things like knowledge graphs and ontologies, and it's really sort of hard to explain what that is, but basically this is what vendors are now referring to as context. And so the CEOs of HubSpot and Workday have talked also on earnings about um, basically floating the idea of charging when agents access context. Now, context is important because if an agent sees customer data, it doesn't know what to do with it at all, but it needs to know from these graphs and the ontologies, like basically it can say, this specific customer made this specific order and it was shipped from this specific warehouse. The very granular kind of understanding that enables agents to do their work. And so that's the stuff that vendors are going to start charging for. And I think that's what SAP was alluding to on earnings. It sounds like they're going to charge, or not charge, but they're going to form new agreements with their partners, their software partners. And through those agreements, this issue of agentic access is going to be addressed.
Great. Well, Kevin, I want to thank you for coming on. That is Kevin McLaughlin, our enterprise software reporter here at The Information. Anthropic is looking for ways to diversify its compute, and my colleagues Stephanie Palazzolo and Anissa Gardizi broke news over the weekend about one startup that Anthropic is looking to for support. I want to bring on Stephanie to tell us what she knows. Stephanie, welcome back to the show. It's great to have you here.
Thanks. Great to be here.
All right, talk to me about how Anthropic is looking to diversify its compute.
Totally. So, what Anissa and I reported over the weekend is that Anthropic has been recently in talks with a London based startup called Fractal, which makes inference focused chips, to potentially become a customer of that startup's chips once they become available at some point next year. So, even though this won't really help Anthropic with its near term compute crunch, which we've been writing a lot about, it could really help the company further diversify its sources of compute in the future. This has also been a really big selling point in Fractal's ongoing funding round that it's raising, where specifically it's looking to raise, more than 100 million in new funding at a $1 billion plus price.
Well, that's a pretty good contract to hang in front of potential investors, saying
Totally.
Anthropic is very much looking to use us. So tell me about Fractal's technology. Why would such a big company like Anthropic be looking to Fractal?
Sure. So I think the first big caveat here is that Fractal's chips are actually not available yet. So basically, the company's CEO has said that they want to start making those chips at some point in the second half of this year, and then they want to make those chips available in data centers next year. So a lot of this is kind of a hypothetical in some ways, but what Fractal wants to do is basically build these chips that are specialized for inference, which is the kind of process of actually running models versus training them. So essentially, these chips would theoretically be able to, run today's large language models faster and for cheaper than NVIDIA chips do right now. And a large part of this is because of a special type of memory that Fractal's chips use, which is also similar to the type of memory used in other chip startups' chips like Grok and Cerebrus. And so this type of memory works better than the memory that's typically used in NVIDIA chips because it basically helps to move the data faster between different chips, which can be a really big bottleneck in terms of today's GPUs that are used to power AI models.
I want to ask you sort of a question here around why Anthropic would be looking to startups as opposed to the big cloud providers that have their I mean, we obviously have NVIDIA. When I say cloud provider, we're talking about Google and their TPUs. Why would Anthropic be looking to a startup, do you think?
Yeah, so Anthropic really has been the poster child already for diversifying its sources of compute. So it already uses, in addition to NVIDIA chips, the TPUs from Google as well as Amazon's Trainium chips. So it's already done a lot of work in diversification. So I think at this point, it's really trying to kind of hedge for the future and say, we are going to have to really look at all these kind of up and coming startups that they might be the ones to create the next breakout chip in the next year or two, and they want to start building those early relationships with those startups early.
I know we've had reports of OpenAI looking to build its own chips. Do you think Anthropic would look to build its own chip at one point?
So I think that's definitely something that they're thinking about. There have been some reports that Anthropic is actually looking to build its own chip, similar to what OpenAI is trying to do, and many other model developers out there, like Google, Amazon, Meta. They all have their own chips, and so I think this is, definitely something that Anthropic is thinking about. It's obviously a very big undertaking to go and like build your own chip. So I think they're just really trying to consider like all different strategies here, whether that's making their own chip, partnering with younger startups, working with the larger cloud providers, just really everything it can do to get any source of compute possible.
Hmm. And last question for you. You mentioned that Fractal is looking to fundraise. Just tell us a little bit about this company's place in the chip ecosystem. Do we know anything about the founders or the story of the company at all broadly?
Totally. So Fractal, again, it's this London-based startup. It has been pretty under the radar, but it was founded in 2022. And so I think one interesting thing about this is, as I mentioned earlier, it from what we're hearing, Fractal is really using this potential deal to, get a lot of investor interest during the funding round. I do think that one interesting thing here, though, is that a lot of this is pretty up in the air, right? So even if Anthropic does move forward signing this contract, they actually wouldn't get the chips for, at least another year, if not further. And Anthropic is probably also talking to all sorts of chip startups. So I think like while this does make Fractal a very interesting, player in this broader ecosystem, I think we have to definitely take this with a bit of skepticism as well, just to see what's actually going to end up happening in a year or two whenever this, if this deal even happens, what is going to actually happen then.
Great. Well, Stephanie, I want to thank you for coming on. That is Stephanie Palazzolo, our AI reporter here at The Information. SpaceX's IPO has public market investors thinking about not just if they will buy, but how they will afford to purchase the company's shares, given how big SpaceX's valuation has grown. My colleagues Corey Weinberg and Valita Poe covered the story over the weekend. I want to bring on our senior finance editor, Ken Brown, to talk us through those dynamics a bit more. Ken, welcome back to the show. It's great to have you here.
Hi, Akash.
So, Ken, tell me, how are public market investors thinking about how they're going to make room for the SpaceX IPO?
Well, that's just it. You have to make room, right? Because most of these guys have, they have some cash, but they're heavily invested in stocks. And so they're going to have to sell something. And so it's a tricky thing because SpaceX is big and it will require a lot of money to go into it. And so, yeah, it's a dance. So a lot of them are talking about, how do I make money? How do I raise money for this? Well, the Mag 7, the other big tech stocks are what I have to start to look at.
So this might be a bit of a stupid question, and I'm not an expert portfolio manager, so forgive me for those listening on the show who are, but why can't you just buy a little bit? Why do you have to make room for a honking chunk of a company that is, a little speculative, a 10, 20-year trajectory? Why do they have to sort of make big bets here on this big company?
Well, so this is all a story about relative return. And this is what a lot of these fund managers live and die by. So I compete against an index, the S&P 500 say. If I lag the index, I'm behind. If I exceed the index, I've beaten the market, I'm a hero, and I take in money. If the only way to take in money is to perform well. So that's the goal. And so all these guys, whether you're an active manager or, just trying to an active manager or pegged to an index where you're just trying to, perform well, SpaceX is going to be a big, as you say, big honking company. And if they really perform well and you don't buy or you buy very little, then you're going to lag behind. I mean, this is what's happened. Any fund manager out there who did not own the Mag 7 for the past few years has lagged behind. And investors are probably pulling money out of their fund. So this is a big deal for these guys, and strategizing around it and how to do it the best possible way is really important for them.
And so just walk us through the calculus here. So now if SpaceX gets added to some of these major indices, as we've seen, there have been a lot of conversations about, then from the fund manager's perspective, it's that, well, I didn't own enough SpaceX basically, because then the index would conceivably rise.
Right. So if it gets added to the indexes and these indexes all seem like they're gearing up to add, then yeah, you really have to. It's not so much like do I want to buy this or not? It's do I want to bet against the index or I want to bet in favor of the index? And so you either underweight or overweight SpaceX. And so it's a real challenge. The real challenge for a lot of these guys, and this is true for most actively managed mutual funds, they're losing money. Investors are pulling money out. This has been true for some time, and they put money in index funds. And so again, if people are taking money out, it's even harder to raise money to buy stuff because you're already selling stocks every day to meet redemptions or every week or whatever. So it's a very challenging moment for these guys.
Ken, there was some great reporting in the story from Corey and Valita about the dramatic lengths that SpaceX is going to in order to woo investors. The top of the story was this flight of 200 investors from Newark to Texas. And look, I don't. Is this a SpaceX-esque roadshow, or is this common in the land of IPO wooing?
Nothing about this IPO is common, right? So everything is bigger. Everything is Elon Musk is the bigger personality. Space and these rockets are a bigger thing. AI. I mean, it is, a bonkers kind of event. And so, yeah, everything is a little over the top. And the market impact is going to be over the top too. And so that's what we're watching.
Now, Ken, we touched on this a little bit at the the Financing AI the Revolution conference that The Information hosted a week ago today in New York. The idea that this IPO, I mean, it could go well, it could also go quite poorly, and there are a million ways that could happen. My question for you is, if that happens, if the IPO kind of turns out to be a bit of a dud, what do you think the ripple effects of that would be on the AI ecosystem, on bigger tech companies? I mean, the stock market is one thing, but talk about the implications.
Yeah, I mean, so SpaceX is different than almost any of these other AI companies because it's a space company and they have a space-based internet company and they have they have X, what was Twitter, and then they have XAI. So, and XAI is burning through a ton of cash. And so the problem is, what will the markets see? Will they see the space business, and that's what they like or they don't like or whatever. So it's going to be hard to discern whether if the IPO does poorly, if it was a bet on it went poorly because of the AI component. It might. You won't really know until the next IPOs. I mean, look, the Mag 7 are basically almost all tied to AI or heavily tied to AI, but they also make a ton of money. They are so profitable. And so, yeah, AI goes badly, it's going to hurt them, but they will survive. The AI specific companies, who knows, right? I mean, they could really suffer. They could disappear. So that's the tricky thing here.
Right. No, in other words, the SpaceX IPO, although it will be the first one, it may not be the referendum on AI companies.
It may not be. Yeah. And it's just mishmash of stuff, right?
Right. Well, makes it all the more interesting to watch.
Yep.
Ken, I want to thank you for coming on. And by the way, I'm in SF. You're in the New York studio. We're trading places.
Exactly.
I look forward to chatting with you more about it. That is Ken Brown, our senior finance editor here at The Information. As SpaceX marches towards its IPO, as does OpenAI and Anthropic, one question that we are waiting to answer is how all of this will affect venture capital. Here to discuss that is Darian Shirazi, a managing partner at Gradient. Darian, welcome to the show. It's great to have you here.
Thanks for having me.
So we talked about SpaceX in the previous segment and how that could affect the AI ecosystem at large. SpaceX is a bit of a mishmash of companies. It's space, it's AI. We, of course, have OpenAI and Anthropic marching towards their IPOs. How are you watching this as a venture capitalist and how it could affect your world of early stage investing?
Well, I think we're pretty positive and optimistic about where things are going, mainly because there's been sort of this lack of liquidity in the venture capital market. And with these IPOs coming up, it's going to be really nice to return capital to investors and LPs such that we can sort of feed the cycle of the next wave of innovation that's coming up. I do think that a lot of these IPOs feel priced to perfection, so to speak. But there are some other IPOs in the AI ecosystem, like Cerebras, that just announced their pricing today, or that they're going to list probably this week. And that one seems to be well priced. The point of an IPO is to raise capital, market your company, and then also to make sure your investors are going to make money, especially the new investors in the IPO. So I worry about that for the ones that are very highly priced. But for some of these others, I think there's a lot of upside potential.
Okay, hold on. So price to perfection versus well priced. What's the difference there? What do you mean by all that?
Price to perfection, I think, if you have a $1.75 trillion market cap for SpaceX when the business is doing somewhere between 20 and 25 billion in revenue, I think that's a pretty rich multiple, even in private.
So perfection is rich in I just want to make sure that I understand the language here.
Exactly. Yes. Price perfection means rich, potentially overvalued, probably not a lot of upside for the IPO participants.
Got it. Okay. And then, but well priced for OpenAI and Anthropic, you think it's a good multiple.
I mean, for Anthropic, I think there's a lot of upside. We saw the business go from 30 billion in top line to 44 billion within a month. I think that, at $1 trillion market cap, that's actually not too bad given where multiples are today. But if we look at other businesses like Cerebras that announced this week that they're going to list, like that one seems to have a lot of upside potential in it, and is one that's quite exciting.
Right. So I hear you on the liquidity piece. I mean, this is something we've talked about on the show a lot, and also the creative ways in which VCs have sought liquidity in this novel IPO environment. But look, I mean, I do wonder, let's say OpenAI and Anthropic go public. Those are the referendums of sort on AI companies and how the stock market reacts to it. Let's say the IPOs don't go the way people plan. Or let's say in the first 6 months, the stock price kind of falls from the pop that they initially see, just like Figma did, for example. I mean, what impact do you think this has on the way LPs are thinking about allocating money to venture capital companies, or even the bets that VC companies are making?
I think even if these IPOs trade off and they don't actually see upward momentum in their stocks within the next first 3 months of the IPO, I still think LPs are going to be very happy with the fact that they are returning such a large multiple or receiving such a large multiple back from the investments they made in various firms that are in these deals. So I actually think that the fact that these get out at all is a positive sign for venture capital.
I'm talking about sort of forward looking in terms of, the next vintage of funds that are raised, the next 3 years of early stage investing. What impact do you think it has on that?
I think it has a very positive effect. I think that we're going to see a lot more LPs jump to get back into the market. We're going to see a lot more venture capital firms at the early stage be able to raise money because the LPs are liquid. And that will yield a ton more companies that are going to get funded at the early stage. I think that more complicated is what's happening in software, is that, Cloud Code has disrupted a lot of software companies. I myself am spend a lot of time in Cloud Code because it's so fun, and you can really rebuild anything that a software company has today. And I think that's more of a problem than the IPOs will be, is that we're going to see investment in all new ecosystems, and it's going to yield much more innovation than I think we had in the past 10 to 15 years, where you just needed to hit a certain number of SaaS metrics to raise your next round of funding. But I'm very positive on, regardless of how these IPOs go, we're going to see a lot more liquidity enter the venture market and a lot more funds get funded by LPs, which will yield a lot more startups that are well funded.
What are you investing in at Gradient right now?
That's a good question. I mean, we have been doing a lot of work and thesis work in the past 6 months because Cloud Code has gotten a lot better, and our expectation is that it will get even better than it is today, and that a lot of the software applications that are seemed defensible or had a moat, like a company like Salesforce, for example, we think is going to get sort of disrupted from the inside out because of the capabilities of Cloud Code in these models. If you look at the future, is that we are spending a lot more time investing in businesses that are not software related. We invested in an AI hedge fund, for example. We invested in a robotics company, for example. We're investing in a human tissue foundry as well that we're very excited about. And these are new cutting edge solutions that are not software based. It feels a lot like 2017 when we launched right after the Transformer paper came out. And that was really an era where innovation was sort of what you underwrote as a venture capitalist, a lot like the 90s and the early 2000s. And we went through this era in the 2010s where it was really financial metrics that drove whether companies were going to raise capital or not. And we're excited to get back to underwriting true innovation, taking technology risk rather than market risk, and focusing on backing the best technical founders that really want to build big category defining businesses. So I think we're looking outside of software, anything that's full stack AI enabled or that is using AI in a cutting edge way to disrupt a market that's outside of software. And I think a lot of venture capitalists are doing that, but many are struggling because a lot of them have finance backgrounds first and foremost, which make it difficult for them to underwrite technical founders and technology first and foremost.
Right. One more question for you. We have reported here at the Information the lengths to which venture capital companies like General Catalyst, for example, have gone to try to help their portfolio companies access compute and deal with the shortage of GPUs that there are in the market right now. Are you doing any similar type of negotiations on behalf of your portfolio to help your companies deal with the chip issue?
Not really. And the reason is that we're not investing in a lot of the frontier model contenders or frontier model lab competitors. I think that a lot of venture capitalists today have poured large sums of money into companies that are trying to train new models that are large models that require significant compute. So on the compute side or the training side, we don't really see that, and that's not really a concern. On inference, that definitely is something that we are concerned about because there will be a lack of inference capability and also supply of inference compute. And we think that's going to become more and more acute as time goes on. We haven't really come up with a solution. Thankfully, we are one of the largest investors in Lambda. We led the seed there, so we have premier access to a lot of capabilities there. We don't have any special deals, but we really are close to a lot of the vendors. We also, one of our biggest investors in the fund is Google. So we have access to really get compute for our companies if we need to, but we haven't had to cut special deals yet. I think that if you're training,
You're talking about special deals between, like, inside your portfolio, Lambda to
correct. We haven't cut any special ones. We may have to.
Do you think you would? Do you think you would?
In the future, I think we might have to, yes, is that the supply of compute, especially at the inference level, is going to be very problematic. It's almost like the same thing that's going on in oil markets, is that you just don't have enough of it, and you're going to continue to see costs go up and up. And what is that going to do is the cost of intelligence will go up as well. And so that's why we're looking at companies that can actually optimize inference. We invested in one called CentML, which NVIDIA acquired for a large sum last year. And so we really are looking at ways in which we can optimize inference as much as possible. But this is an unsolved problem. We're going to see compute costs go up. And it's one of the reasons why I'm so bullish on a lot of the hyperscalers and the neo clouds, is that there's just nowhere for these companies to go if they need access to inference or training or any form of compute.
I am curious about these so-called special deals that you talked about. Is that common? Is that happening more and more? A venture capitalist that has investments in, we'll put aside chip companies for a moment because they're sort of in a different landscape. But I mean, cloud companies, neo cloud companies, are these deals more and more common? These intra-portfolio deal making?
I haven't seen them be quite common yet. I presume they will become quite common. Although I don't know what it's in it for the company providing the compute yet. That's definitely going to be a cost that we as the firm would maybe have to bear. And there are a lot of firms that are willing to do that. So far, we haven't needed it, but I predict we will have to do something in that regard. It's that it is going to be the advantage. If you have access to the latest chips, if you have access to large scale compute, it's going to be needed. So I do think it's a special benefit that will have to be offered. Similarly to how you used to get cloud credits, right? Like you get a certain amount of cloud credits if you're a new startup that's raised a seed round from a certain venture capital firm. We're going to see that sort of expand to sort of GPUs and other forms of compute.
Great. Well, Darian, I want to thank you for coming on. That is Darian Shirazi from Gradient here on TITV. That does it for today's show. A reminder, we are on this stream Monday through Friday at 10 a.m. Pacific, 1 p.m. Eastern. If you can't make it then, episodes are available on theinformation.com, on our YouTube channel, or wherever you get your podcasts. Make sure to follow us on social media, on X, on Instagram, on TikTok. I'm already excited for our next show tomorrow. Have a great rest of your Monday. Bye-bye for now.